experts wherein we try and talk about stocks that one can look at for the next Samvat. Now, there are probably a million such shows and articles already out there. You must be inundated with a bunch of ideas already. What we thought, as we do every year, is to try and have a slightly deeper conversation about why some of these ideas might make sense. And therefore, that is what we'll do. We'll not give you 20 ideas on this show. The idea of this show is to try and keep a restricted list of 4 or 5 or 6 names and talk about them in slightly more depth so that you get a sense of why you are investing in that as well if you choose to invest. And fairly noted names on the show today. They need no introduction, but cursory sake, so let me do that the way I see them on my screen. Mayuresh, Joshi, Dipan, Mehta, and Sudip, Bandyopadhyay. Gentlemen, all of you, thank you so much for joining in. And to you and yours, a very happy Diwali and a prosperous New Year. Okay. Yeah, I know it becomes difficult for all 3 of you to say, so let me address you one by one. Mayuresh, can I start with you? Well, very quick 30-second question to each of you first before we get into the ideas. Mayuresh, every Samvat, we fail to recognize what the markets will do over the next 12 months, and that's true for everybody. But do you reckon the markets could do better over the next 12 months? Not relatively, but from where we are right now? Quick 30-second view.
Afternoon, Neeraj. First of all, a very happy Diwali to you, your family members, and the entire team at BloombergQuint. So I think the quick answer to your question is the outperformance that we've seen in the last 12 to 18 months. I think the markets will find that difficult to replicate. So I think we will have normalized growth looking at macro conditions globally, locally as well. And to expect that, I think should be the base case scenario for investors for the next year and a half. But India is positioned very well, Neeraj, on the macro front as far as policy making is concerned. And therefore, I think the earnings trajectory should hold out for selective sectors. So I think it's going to be a stock pickers market when it comes to sectors and stocks.
Awesome. Thanks for that, Mayuresh. Dipan, quick thoughts from you. Do you reckon that there is a possibility that we might need to be into defensives and value stocks, or do you reckon growth stocks could continue to do well next 12 months?
Yeah, Neeraj, first of all, season's greetings to you and the entire team at Bloomberg.
Thank you.
So my sense is that in the next 12 months, over the next Samvat, we should at least have one serious correction. And one cannot see the reasons why it will come, but intuitively, I think when markets have rallied the way they are and seeing the kind of froth which is there in some of the counters and the IPO market, I would at least factor in a 15%, 10-15% type of a correction in the next 6 to 12 months or so. And at that point of time, being in the defenses will certainly help. So I would say that at this point of time, from this point on, I think incremental flows should be in defensive stocks, the large blue chip companies, the index companies. And while you may be missing out on a lot of the fun and games happening in the small mid-cap stocks, I think that's a much safer strategy. As we speak, I think the risk return profile is certainly not in favor of investing in many of the counters which have given kind of multi-bagger returns over the last 18 to 24 months or so. So I would like to just start the next year on a bit of a cautious note and just watch out for events which may be negative, which we cannot kind of imagine at this point of time, but law of averages will certainly catch up with us.
Okay, Sudip, with the presumption that with the kind of rally that we had over the next 18 months, there could be a correction in the offing. The larger question that remains is, could it be a brutal one which could make the next 12 months be of people losing more money as opposed to making more money? Or do you reckon that that may not be the case necessarily?
Well, Neeraj, wish you and the entire BloombergQuint team a very, very happy Diwali.
Thank you.
I think 40+% return Nifty has given over the last, between last Diwali and this Diwali. So from today where we sit, I think that kind of return for the next Samvat may be difficult. But I expect around 20% return, provided you have been selecting stocks carefully. So I will kind of agree with Dipan bhai. It's extremely important now to carefully select stocks. There are certain dangers which are around the corner. One is definitely the tapering, which we are all talking about. One doesn't know when it will happen. One doesn't know the ferocity of the tapering and the kind of risk of mood the global investors will have when that tapering happens. I have another worry. That's the geopolitical angle. We normally don't talk about that in the market, but that's something which I think we should keep in mind, and that can at some point of time derail the market and we can see a massive correction. So while you need not necessarily be purely a defensive oriented investor now, I think carefully selecting stocks in this Samvat will be extremely important, and investors will do well to be careful in this Samvat.
Viewers, point well taken, and keep in mind the skirmishes of words between US and China refuses to die. If anything, the week gone by had a bunch of these news flows as well and should be kept an eye out for. Sudip, so let me start with you. Is that the reason why one of the ideas that you're choosing is NTPC? Give us the rationale of why should somebody invest in NTPC for the next 12 months?
Well, I think first let me start by saying that we have seen a lot of excitement in the power stocks in the recent few weeks. And there is a reason for that. I think we are not realizing the importance of power in everything we do. I think it's a commodity, and we treat it like a commodity which is abundantly available. We have seen what's happening in China, which was supposed to be, the leading the world and trying to become the #1 economic power, and they are having massive outages. We, of course, have been seeing multiple outages across the country. There were a lot of concerns, but the reality is power is absolutely basic to all what we do today. Whether it's the online buying, whether it's gaming, whether it's Bitcoin, any new business, any emerging business you talk about requires power. And I think that's where NTPC comes in. It's got 17% of India's generation capacity, 23% of actual generation comes out of NTPC. And remember, on top of what they're doing, they have also announced a massive green energy plan. They're talking about 60 gigawatts of green energy being in place out of their kitty of 138 gigawatts by 2032. I think that's a commendable aspiration at this stage, but they are moving towards it. They have created a subsidiary where they are putting all the renewable stuff, and that itself indicates towards the possibility of value unlocking at some day. Now, apart from this excitement which is happening, look at the basic nuts and bolts of NTPC. They are one power producer which have got the coal linkages properly sewn. I think this is the best position to handle the coal requirement because of their existing tie-ups. 85% of their requirement is tied in. This cannot be said of any other power manufacturer in this country who sells in a large scale. On the other hand, look at the PPPs where they sell powers to the discoms. Again, NTPC is way ahead of other power producers. So I think that gives NTPC a very good, steady, stable earning potential, which should continue for a very, very long time. Apart from all this, I think the dividend yield sometimes does excite us, and that also one should keep in mind while investing in this. Now, if you come back to the market lingo, compare their multiples, any yardstick you take, compare NTPC with any other private power producers, you will realize that it is grossly undervalued on a peer comparison basis. So I think if you want to play safe and you want to ensure that you have a regular return, I think NTPC is a good buy. We have a target of 200 for a 1-year hold.
Sudip, just very quick follow-up. NTPC or some of the other power stocks, you still believe NTPC is good risk versus return? Because everybody seems to have taken a fancy to Tata Power of late because of the EV plans and whatnot.
Absolutely. And if you look at this, these guys also have EV. These guys also have green energy plan in a massive scale. Okay. Sometimes we try to discount the PSUs. And they've been doing it for a very, very long time. I think probably now the time has come to relook. Government is serious about disinvestment and a whole lot of other things. So we should not discount the PSUs to that extent.
Okay. Yeah, well, some of the PSUs, and everybody knows the one name, which was a PSU and which made a lot of money and then suddenly lost a lot of money too. So PSUs can certainly create wealth when they want to. Thanks for that, Sudip. I'll come back to you. Mayuresh, can I come to you for your idea? And I know you've given me 3 names. I'll save the slightly boring one amongst the 3 for the last, if we have the time, which is Ultratech. But let me talk about the 2 mid-sized names and the first one amongst them. Why a tire company and why JK Tire within that?
So Neeraj, I think the logic that we are going out with is that the worst in terms of the auto sales because of the pandemic is largely behind us at this point of time. Now, all the ancillary factors surrounding that, OEM sales getting stuck up, last 2 quarters, you've obviously got a surge in the semiconductor issue, which has led to a lot of plant shutdowns, bringing in for the OEMs itself. But generally, I think things should start smoothening out over the next quarter or two. And the markets always start factoring in 4 to 6 quarters beforehand. So I think the next fiscal should be far better on what we probably see for JK Tyre in the past 12 to 18 months. Now, as far as numbers were concerned, specifically Q1, input cost inflation has been rampant across sectors, no exception for JK Tyre as well. You've seen natural rubber prices zoom off. You've seen synthetic prices zoom off as well. Steel cords prices zoom off, and crude derivative prices zoom off. So the EBIT margin and the EBITDA margin itself have come under some sort of pressure. But I think that should be seeing signs of stability in the next quarter or so. Again, when you're probably looking at numbers, the Mexican operations are expected to do well. The Cavendish operations, specifically when it comes to utilization levels, should start picking up steam. And when you're looking at debt reduction, they've reduced 900 odd crores in the past fiscal. The management is very, very hopeful of reducing 700 and 800 crores more in this fiscal, which basically means that the net debt equity from 1.6 times should halve in the next year or year and a half. Again, the capex that is required at this point in time is minuscule compared to what they have done in the past. And therefore, as demand comes up, with the replacement markets holding out for all tire companies and accounting for 54%, exports accounting for 18 to 20 odd percent, and export markets expected to continue the volume-led price growth. Margins should hover around 12 to 30% over the medium term. And therefore, with reduction of debt, cash flows improving, return ratios should also show significant signs of improvement, along with pickup at utilization levels, the sweating of the assets, and better absorption of stocks. So the presumption here is that things will be far better over the next couple of quarters and should improve drastically in the next year. And balance sheet dynamics, as they improve, should start showing on valuations and the prices.
And you reckon that raw material cost pressures will ease off in a quarter or two?
Seems to be the case. So I think in a couple of quarters that should start easing.
Okay. Nice for that, Mayuresh. So here's JK Tyre from Mayuresh Joshi. A bunch of assumptions, of course, out there, which he's laid it out beautifully for us. If you look at the argument about the international operations and otherwise, maybe it's something that you might want to look at. Dipan, true to style and what you mentioned at the start, which is that you are being cautious, you're opting for one of the largest banks. I have a follow-up question to that, which everybody would guess. But before that, let me request you to make your case for why HDFC Bank.
Yeah, see, I think that HDFC Bank has been a big underperformer. If you take a 3-4 year type of returns and compare to the Sensex Nifty, it's been a big underperformer. And many of the other banking and non-banking stocks have done well over the last few years. But although HDFC has returned positive, by and large, they have lagged the Sensex Nifty. And I think it's about time that such a great company should play a catch-up. They've been an exceptional wealth creator over the past several decades or so. And the way they have managed all the various crises in the banking industry is quite legendary, I would say. It's been one bank which since its inception has never got into any NPA type of a quagmire or issue, and they have consistently maintained the highest amount of reserves for managing their NPAs, and which have generally been very much under control. And they've been responsible lenders by and large. And now with the economy opening up the way it has and so many sectors doing well, GDP growth rates moving up, they should see very good demand for credit. And HDFC Bank is now truly completely well spread out into the country, offering every single product which is there as far as the bank can offer. And now with the economy revving up, we should see credit growth moving up for HDFC Bank, and their credit costs will remain very much under control. So on one hand, you have the net interest income significantly moving up, and the credit costs will remain low, and they've done a lot of innovation as far as technology is concerned, So the overall overhead costs also will remain well within their expected range. So what we'll have in play in HDFC Bank is good amount of operating leverage over the next 2 to 3 years or so. And at around 26 times or thereabout trailing 12 months, there is certainly scope for the price to earnings multiple also to move up. They've been consistently gaining market share, and there's no reason to believe that they will not do so in the future. There's considerable scope for them to grow in all the various channels which they are operating in. And at the same time, you have the safety of a superb management, and whatever issues were there about change of top guard, those are now almost behind the company. So very positive on HDFC Bank. And this is the time to build a good quality portfolio with HDFC Bank at the center of it as a core holding.
Interesting. Dipan, just the obvious question though, when I see the results for the last 2-3 quarters, almost every sell-side analyst worth heard or his salt talks about how ICICI Bank now seems to have taken the mantle of being the growth leader, and their internals are improving quite dramatically over the last few quarters too. And still, in terms of valuations, it's probably not as expensive as HDFC. Not that HDFC Bank itself is as expensive as it used to be. But my question is, why not an ICICI Bank as a top idea compared to HDFC Bank?
I think both are equally good.
Okay.
It's just that we tend to ignore the obvious. And ICICI Bank has rallied significantly over the past couple of years or so, once they've got out of the NPA issues. Whereas HDFC Bank has been more or less been a steady performer. And my sense is that the management has been conservative as far as lending is concerned. And now that the environment is much better, you would see a lot of surprises as far as the performance of HDFC Bank also is concerned. And in terms of capital, in terms of technology, in terms of management bandwidth, there's nothing to match HDFC.
And don't forget, viewers, the credit card business is back on track, so to say. And we know what's happened ever since they got their permission, half permission, if you will, and the numbers that they have really created as a result of that. So pretty interesting choice. Thanks for that, Dipan. Now, coming to a company which a lot of people might still not know is not just an electric company. Sudip Bandyopadhyay, Surya Roshni. It's been a rank outperformer of sorts as well over the last 12 months. But why do you recommend this as something that you look at for the next Samvat?
Well, I think, as you just rightly said, people think that this is just a lighting company. Yes, it is the second largest lighting company in the country. And we know lead prices have bottomed out and there's a significant scope for growth and margin improvement through the lighting segment. But, leave that aside for a minute. The company mainly is focused on GI pipes. They're the largest exporter of GI pipes from this country. They're the largest manufacturer of GI pipes as well. And they're completely focused on GI and API pipes where the margins are fantastic. And this gives them a huge opportunity going forward as well. Remember, this entire China issue is giving a significant opportunity for them to ramp up exports. So the core business of the GI pipes and API, I think that itself should be re-rated. Now, on top of that, we know that lead prices have bottomed out and there is a significant scope for growth and improvement of margin there. Now, on top of these two, they have entered the consumer durables and home appliances segment. Now, remember this segment, they will draw upon the distribution strength. And being a LED and a lighting manufacturer and distributor, they have a very, very deep penetration across the country through dealerships and through distributorships. If they're able to successfully utilize this network for their consumer durable and home appliances business, I think sky is the limit. They can do wonders. Now, probably the market is not yet digesting the entire story. We believe that probably there is a re-rating warranted here. And we have a target of about 900 for 1 year. It is a bit risky bet vis-a-vis my earlier bet of NTPC. But I think, portfolio, you need to have a mix. You need to have a very, very steady and stable stock along with a little bit of aggressive. So Surya Roshni is my little bit of aggressive bet.
Surya Roshni is your Rishabh Pant, if you will. He's taken over the mantle in the Indian cricket team. I'm going to ask Mayuresh to tell us why Orient Electric in the same space. But before that, Sudip, the question to you is, there's a lot of talk about how real estate is on the cusp of a big boom. Does that feed into the home appliances and the electrics business for Surya Roshni? And I heard you mention that 900 is your target, but that's your first target, is what you said. So you reckon it's set for a long innings here, Surya Roshni?
Absolutely. I think you are absolutely right, Neeraj. I didn't touch upon that. I think the way the housing for all, home improvement, and the real estate sector is behaving is very clear that the demand for consumer durable home appliances, lighting, this is absolutely real and is shooting through the roof. There should be a lot of beneficiaries in this segment, and I'm confident Surya Roshni will definitely benefit out of this entire boom.
Got it. Okay. Mayuresh, now to you. You kind of have a stock within the same segment, if you will, right? Orient Electric, home appliances out there. Why do you like an Orient Electric? I can well ask you, why do you like an Orient Electric over Surya Roshni, but let's not do that.
No, so I like both. So I think I would concur with what Sudip was saying in his logic and rationale. But for Orient, again, I think as you rightly pointed out, Neeraj, I think the numbers in the last quarter, the previous quarter, have been stupendous. I think the top line growth was fabulous. Assuming the kind of pressures that we've seen specifically on the supply side, input cost inflation, again, as I said, aluminum prices, steel prices, copper prices going through the roof. And yet they were able to successfully manage their EBITDA margins at 10.4%. The second aspect, as Sudip also pointed out, is the distribution and the brand itself. So I think rural India, semi-urban India, I think that is when the growth dynamics are going to come over the next few years and the next few decades, if you will. With the government initiatives, with discretionary spending going higher, I think the first point becomes to buy a fan rather than an air conditioner, specifically rural and semi-urban areas. So I think the fan segment, which is predominant for Orient Electric, almost 60% to the top line, with the electrical segment contributing 25-30%, and the consumable electrics, or durables as we call it, 10 or 12%. I think that is when the next leg of growth will come through. The premium fans, I think we could distinguish that as a price point of 4,000, 4,500 odd rupees, and the entry-level fans or the decorative fans from 2,000 odd rupees. The premium fan mix in the overall mix is just 10%. So I think that is where the next leg of growth is expected to come, specifically in semi-urban areas. And with more dealerships and distributions taking shape, the whole volume-led growth will definitely lead to a substantial increase in top line, which my presumption is could be anywhere between 18 to 20%. We've got a cost optimization program, which should lead to EBITDA margins at 11-12%. 240 crores net cash on their balance sheet, and therefore the return ratios are one of the best in the industry. ROC is 35%, ROE is 28%, return on invested capital 31%.
Sorry, did I hear you say that you expect a top line growth of 80 to 90% over the next 12 months?
18 to 20%.
18 to 20. I was wondering that, did I mishear? 80 to 90% would have been quite stupendous, though. I don't know. Quarter two numbers seem to suggest that some companies are having some tremendous top line growth, but the problem seems to be at the margins. But yeah, okay. Mayuresh, just very quickly, any risks to this thesis?
No, so I think if there is a third way, which I hope there is not, and the entire aspect in terms of not being able to pass costs through, I think that might be a risk factor, but I don't think any of this would play out. So I think being optimistic on all this.
Oh yeah, I mean, we don't need that to come for sure. Okay, thanks for that, Mayuresh. Dipan, to you, and again, maybe a stock that has largely underperformed over the last recent future, and I dare say, a stock which, as blue chip as it is having its subsidiaries perform way better than its core business. Larsen & Toubro, why do you like it?
That's right. I think the first part you said is about the underperformance. It's been a multi-year underperformer, and a company like Larsen & Toubro, with the kind of position they have in the industry, it doesn't. I can understand why it should underperform the way it has. And I'm not buying Larsen & Toubro for its software subsidiaries. I think those are independently listed and are available for investors to buy into. But the core EPC business is now reaching an inflection point. What investors need to understand is that there are certain projects in India which only a Larsen & Toubro can do, like the coastal road or some of the other infrastructure, large infrastructure projects, only they can do. And that's where they have their edge in terms of pricing and in terms of growth in order book. As we speak, they are almost order book is full for the next 3 years. They are focusing very aggressively on the overseas markets as well, especially the Middle East, where the prospects are improving because of higher oil prices. And if you notice last 2-3 quarters, they've been consistently increasing their operating profit margins because they are selectively bidding for projects which offer comfort as far as the gross profit margins are concerned. The price increases in commodities are more or less all passed through. And last but not the least, is the valuation, that for a company of this size and this kind of a visibility and what growth they can generate, it's a very attractive valuation, especially if you strip out the holding which they have in the other listed companies. So very positive on L&T per se, and they've been managing their capital exceptionally well. They're getting out of all the development projects. They're not focusing further on the real estate projects. As much as possible, they're trying to monetize all the investments which they have made. So you could even see the return on capital employed of the core EPC business move up significantly over the next 2-3 years. And as and when you have the return ratios move up, there is more comfort and space for the price to earnings multiple also to expand. So what we have in L&T is that the earnings next 3 years will grow compounded at least 15-20% or so. And there's a good scope for the P multiples also to move up. So I think that L&T could be a fantastic outperformer over the next 2-3 years or so. And certainly over the next 12 months, we have very good visibility as far as their earnings and profitability is concerned.
So when the Q2 numbers came out, Dipan, everybody was talking about how the large order inflow is amiss even now. And maybe that is a big trigger. You would wait for the trigger to happen, or would you nibble or buy in bulk even right now?
No, I think the stock price hasn't run up as much. And as I said with the first stock, also HDFC Bank, I think both companies, if you have incremental cash flow coming in or incremental funds to invest, you could certainly allocate to these companies. And then if there's a correction and you still have the liquidity, then you can look at buying into it more. I cannot really, give a guess as to when one should time the purchases. Even as we speak, I think they are attractive buy positions.
Okay, great. Well, I think we've just enough time to maybe squeeze in a quick couple of questions to Mayuresh and Sudip for a third idea which they were given us as well. Sudip, may I quickly request you to talk about Gateway District Parks, isn't it?
Absolutely right, Neeraj. I think this is one unique company which is a play on the integrated intermodal logistics as far as Indian markets are concerned. And I'm betting on Indian economy and the growth of Indian economy here. 70% of Gateway's business is rail related. Now, what is happening in the rail is that there is timetabled freight trains. There is double stacking which has been allowed. Now, all this augurs excellent for Gateway's margins and business going forward. This is what they have been asking for quite some time. And these things coming in will bring certainty, improve efficiency and margins. And the consumers, people who are using their services will like more and more rail, which should give Gateway an edge over other players. The other point here is that there are very, very strong balance sheet. They're in the right locations to seize the opportunities as and when they arise. So overall, I think Gateway is fantastically positioned to capture the growth and export-import potential of India. So 350 rupee as a target for 1 year, and one can definitely look at Gateway. This is also a safe bet. This is not something you're taking a huge risk, remember.
Okay. And in the similar vein, Mayuresh, the final word to you. Ultratech, safe bet largely, but why cement feeding into everything, and why Ultratech within cement? Very quickly.
So, Neeraj, I think the logic is very simple. I think infrastructure spending, both in terms of CapEx-led government projects, as well as the rural and urban housing trust, that should gain significant traction in the next few quarters. Ultratech, being the largest player with a presence across India, should benefit significantly from this. Yes, again, input cost inflation, petrol prices have gone through the roof, around $160, $165 a ton at this point of time. Logistic costs, specifically diesel prices, have gone higher, and therefore I think the EBITDA compression might be stark in the next couple of quarters, but that should normalize going forward. Trade sales, 70% of volumes, rural sales near at 65% of total sales, pet coke mixes at 17%, and blended cement realizations account for 72%, along with overall utilization next of 70-75. So operating leverage should definitely kick in and should play out meaningfully in terms of ROCs and the reported EBITDA.
Okay, gentlemen, all of you, thank you so much for joining us today on this very special show and giving us your thoughts. And from everybody out here, Shubh Diwali and a great new year.
Thank you so much.
Thank you.
And viewers, thanks for tuning in to you and yours as well. Please stay safe.